For the bond market, the primary impact will be rising inflation, as import tariffs increase the cost of imported goods. Tax reductions will boost net wages, leading to higher disposable income, but this will also widen the budget deficit and increase public debt. Additionally, the deportation of undocumented immigrants will reduce the availability of low-cost labor, which will need to be replaced at higher costs. These factors are expected to drive up US inflation. This scenario could have two key consequences for the bond market. Future rate cuts may be smaller than currently priced into the US yield curve, effectively resulting in higher interest rates than anticipated. This has already been partially observed this year. Rising inflation, combined with more modest rate cuts from the Federal Reserve and an increase in net bond issuance to finance a growing public deficit, is likely to further steepen the yield curve, with short-term rates falling and long-term yields rising. This trend is already beginning to materialize in the US curve. In Europe, the situation is entirely different. The economy is struggling. Germany is in recession, and entire sectors, such as automotive manufacturing, are in crisis. Meanwhile, inflation has dropped below 2%. This creates room for the European Central Bank, ECB, to cut rates more aggressively than the Federal Reserve, supporting short-term bond prices in the Eurozone. However, a steepening of the yield curve is also expected in Europe, with short-term rates declining and long-term rates rising due to inflationary expectations tied to the ECB's monetary easing policies. As for equities, short-term forecasts are challenging. US equities are already significantly overvalued, making it unlikely that future returns will match past performance. European equities, on the other hand, may face headwinds due to ongoing economic difficulties, which could persist for some time. In the foreign exchange market, the widening short-term interest rate differential should support the dollar against the euro. Meanwhile, energy commodity prices could decline as the Trump administration introduces more stimulus to the sector, particularly oil and gas. Gold, which has risen significantly under Biden's administration due to geopolitical tensions and the seizure of Russian reserves, could see a decline if global conflicts and international tensions ease under a new Trump administration. After years of near-zero interest rates, European bonds now offer attractive yields, ranging from a minimum of 3% per year for ultra-safe money market instruments to as much as 8% for subordinated financial bonds. These present compelling opportunities for conservative investors who want to avoid excessive exposure to equities. Given the expected steepening of the yield curve, I would avoid investing in long-duration bonds, particularly for those who have bet on long-term instruments anticipating price increases from short-term rate cuts. Short and long-term rates do not move in the same way, and with a steepening curve, ultra-long bonds could suffer significant losses. Corporate investment-grade bonds have seen a considerable tightening of spreads, now offering modest yields, which makes them less appealing, especially for Italian investors facing a 26% tax rate. Instead, I would focus on Eurozone government bonds with maturities up to 5 years, benefiting from the curve steepening. High-yield corporate bonds with yields around 6%, corporate hybrid bonds yielding approximately 7%, subordinated bonds offering up to 8%, all with relatively short durations of around 3 years. Investing in inflation-linked bonds is also advisable, as they are currently undervalued and offer protection against potential inflationary pressures under the new Trump administration. Additionally, I would maintain a liquidity buffer in money market instruments, which provide a solid 3.25% annual return to capitalize on any future buying opportunities in the equity market. At current levels, I would tend to reduce exposure to equities.